Hello guys and welcome to my channel. This video is all about the absolute best way to trade any market and any time frame. Understanding this way of trading is so important for anyone interested in being consistently profitable. I believe looking at the markets in the way I'm going to describe will exponentially increase your chance of being a successful trader. So hang tight and get ready for how stupid simple this is. It's really simple, but that doesn't mean it's going to be easy. Before I get any further into things, just be sure that you are subscribed to my public Telegram channel in which I show more long-term trends for free. Just follow the link in the description and subscribe to my Telegram channel about trading on cryptocurrencies. Right now I open a post where you can find a list of altcoins that I will personally buy at the next correction. I also want to say that I trade on the PrimeXBT exchange. This is the best solution for opening futures and margin trades. Also, right on the platform you can find a section where you can already copy other people's transactions. For example, these guys made about 10,000% for this month. Register using my link and you will receive an incredible bonus specially from me. Okay, now I will be showing you everything you need to know about Fibonacci retracement strategy and how you can use it in combination with price action. And so what you will learn from this video is first, how to actually plot them properly onto a chart. Second, how to find the high win rate trade entries using Fibonacci levels. And third, how to properly exit your trade to get as much profit as possible. Now let's start with the basics. What are Fibonacci retracement? So Fibonacci retracements are key levels based on the Fibonacci number that lets your identity the end of a pullback. And we can generate these levels by using a tool called the Fibonacci Retracement tool. Now the question is, why should you use this tool to identify pullbacks? Let me give you a scenario. So let's say that the current market is trading and you're looking to enter a position. Now we know that the best time to enter a position at a trading market is to wait for the trend to make a pullback. So as price makes a pullback, you can enter a buy position at the end of the pullback before the price counters with the main trend. And so how do we know that this point will be the end of the pullback? Well, a pullback tends to end at a previous key level, like in the example. Here we can see that the price went up and consolidates at this level, making this a level of resistance. Next, we saw the price broke through the resistance level and made a pullback. Now notice where the pullback ended, the previous resistance level that we drew earlier. And so it's widely known that pullbacks tend to end at a key level. However, what if the chart looks like this instead, where the price went up and made a pullback, but there are no previous key level? How do we know when this pullback will end? And this is where the Fibonacci retracement tools comes in. So, as I plot the tool onto our chart, and notice that we now have these Fibonacci-based key levels generated by the tool, and as you can see, the price hits one of the levels and bounce upwards. So it's widely known among traders that price tends to respect these levels. Another example of this would be the Bitcoin crash back in March 2020. So here, as we apply the Fibonacci retracement tool, you can see that the level predicted the exact bottom of the crypto market crash. And now I'm going to show you how to apply this tool onto your chart and how you can use it to find high win rate trade opportunities. Now if you're using TradingView, the Fibonacci tool can be found on the left side of the screen, so you click it and select Fibonacci retracements. Now for the settings, I want you to copy this exact value that will be easier for you to follow along. And so here is how you apply the tool onto your chart. So the first step is you want to find a clear trend, like in the example. Here we can see that the market is clearly moving upwards. Now once you have identified the trend, the next step is applying the Fibonacci retracement. So to apply the Fibonacci retracement, you first need to identify both the swing low and the swing high of this trend. So a swing low refers to the lowest point the price reached before reversing upwards, and over here we can see that the price slightly went down before reversing back up. And at this period, this was the lowest point, and so this will be our swing low. Similarly, a swing high refers to the highest point the price reached before reversing downwards, like in this example. Up here, we can see that the price went up and slightly made a pullback. And at this period, this was clearly the highest point, and so this will be our swing high. And remember, in order to identify a swing high, a small pullback at the end of this trend needs to happen first. Now, once you've identified the swing high and the swing low, the next step is drawing the Fibonacci tool by correcting the swing low of the swing high, and then drag it to the right to extend the levels. Now notice that I'm connecting them at the end of the candle's wick. As you can see, we now have the Fibonacci levels in place, and again, I advise you to follow the custom settings that I have so that it will be easier for you to follow along. So now I'm going to show you how to utilize these levels. So starting from the top, you have your 0% level, which is basically your starting level, and below that 0% level are your Fibonacci retracement levels, which are levels where the price may pull back into. Now, the most common level where the price may pull back into are these three levels: 38.2%, 50% and 61.8%. These three levels are called the golden zone. However, that doesn't guarantee that the price will reverse at these levels. It can always break right through and go towards the deeper levels like the 78.6% and the 100%. Now the 100 double is the maximum level where the price can still be considered as a pullback. Let me explain. So if the price moved downwards but remains above the 100 double, it indicates that this downwards movement is still considered as a pullback, meaning there is a chance that the price can still go back upwards. But if the price moves downwards but breaks below the 100 level, it indicates that this downwards movement is no longer considered as just a pullback, but rather it can already be classified as a downtrend, meaning the price is more likely to continue downwards. And so if the price breaks below the 100 level, you cancel your trade and look for other opportunities. Now, a key point that you need to remember is that you need to treat these levels exactly like support and resistance, meaning we treat them as areas, not as solid lines. So now the question is, how do we know at which level will the pullback end? Well, just like normal support and resistance, you cannot immediately take position just because price touches one of the levels. You need to wait for confirmation by looking at the price action. So let me show you an example. Here we can see that the price made a slight consolidation, then proceeds to break below the 38.2 level. This shows is that the price is clearly not respecting this level because it showed no reaction at all, meaning the price will not likely bounce at this level. Next, we can see that it also broke the 50 level without any reaction, again indicating that the price doesn't respect this level. Now, as price approaching the 61.8 level, notice what's happening. The price showed a small reaction at this area as it failed to break below it multiple times. But remember, a reaction doesn't equal a trade because price can always react to a level but still break right through. And so you need further confirmation. Next, we also spotted a bullish engulfing pattern, which is when the second candle's body completely covers the previous candle. And so what this shows us is that not only do we have a reaction in this area, as shown by this candle's rejection, but we also have upwards momentum as shown by this bullish engulfing pattern. Then, to further confirm the upwards momentum, we can see that the next candles after that are multiple green candles breaking above resistance at the 50% level. Now let's recap what we have currently. First, we have price showing a reaction at the 61.8% level, as shown by the multiple candles failing to break below it. Then we have a bullish engulfing pattern, indicating that there is some sort of upwards momentum at this level. And finally, we have the multiple green candles breaking above the resistance at the 50% level, which further confirms the upwards momentum that we already have. So, based on the price action, it's likely that the price will bounce off at this level, and so this is a good opportunity to take a long position. Now, just in case the trade falls, you need to have your exit strategy in place. So for your stop loss, you can place it at the swing low, and for your profit target, I like to set it the 0% level. And as you can see, the price hits our profit target, and so this counts as a successful trade. Now moving on, you can also combine existing support and resistance levels with Fibonacci levels to create an area of confluence, like in this example. So here we can see that the price went up and made a slight pullback, and so you can apply the Fibonacci tool to predict the end of this pullback. And again, you can connect the swing low to the swing high and drag it to the right to extend the levels. Now the next step is to wait for the price to show reaction to one of these levels. And as you can see, the price made a pullback towards the 38.2% level and showed a slight reaction, as seen by these three candles consolidating at this first. But again, a reaction doesn't equal a trade, because price can always react to a level but still break right through. And so we also need signs of upwards momentum. And after that, we can see the price broke below the 38.2% and ended up at the 50%. Now, if you look closely, you can actually see that this level is also aligned with the previous resistance level, because at one point the price went up to this level and reverses downwards, meaning we now have an area of confluence. And usually price has a high chance of bouncing at this level, and to further confirm that, we can see that the next candles after that are multiple green candles breaking above the 38.2% level. So let's recap what we have currently. First, we have price pulling back towards an area of confluence, which is Fibonacci level, and a resistance level at the same time. And second, we can also see signs of upwards momentum indicated by multiple green candles breaking above the 38.2% level. So based on this, we can conclude that the price will likely bounce at this level, and so this is a good opportunity for you to take a long position. Now, here is where people tend to get confused. If you look to the right, you can actually see that the price moved upwards before going downwards. And so the question is, how do we know that this downwards movement is downtrend itself and not just a pullback as part of this uptrend? Well, the way we know that is by identifying the long-term trend using the 200 EMA indicator. And in this example, we can see that the price is below the 200 EMA, meaning this downwards movement is in fact a downtrend. Now, once you've identified the downtrend, the next step is applying the Fibonacci Retracement tool. And since it's bearish, you want to start from the swing high and connect it to the swing low. And again, drag it to the right to extend the levels. The next step is wait until the price shows a reaction to one of the levels. So you can see as price approached the 38.2 level, we spotted a multiple small candles failing to break above the level, indicating that the price is actually reacting to this level. Next, we can see a green candle that broke through the 38.2 level immediately, followed by a big red candle that engulfs the previous candle. So what this shows us is that at one point buyers pushed the price upwards, as shown by this green candle breaking above 38.2% level, but then sellers came in stronger and pushed the price back down, even as far as surpassing the previous candle's opening, price indicating that there is an actual downwards momentum in this area. So again, let's recap what we have currently. First, we have price pulling back towards the Fibonacci level. Second, we have price reaching to the Fibonacci level. And third, we spotted a bearish engulfing pattern indicating there is some sort of downwards momentum as price touched this area. So based on this, it's likely that the price will bounce off this level, and so this is a good opportunity to take a short position. Now to summarize, here are 4 key takeaways from this video. The first one is that Fibonacci levels behave exactly like support and resistance, so treat them as areas, not as solid lines. Second, before plotting the Fibonacci retracement, make sure to identify the long-term trend first, and you can do that by using the 200 EMA. Third, always wait for confirmation before entering a position. And fourth, you can combine previous support and resistance levels with Fibonacci levels to create an area of confluence. And before we finish this video, I want to remind you that PrimeXBT platform, which is one of the best platforms for opening futures and margin position. In addition, you can go to the free copy of trade session and open your position together with the trader you subscribe to. Follow my link in the description and register on PrimeXBT